When did gold have its highest purchasing power in terms of other commodities? When was its real purchasing power at an all-time high? That was on March 16th, 2020. Right? That was like at the depth of that crazy crash when gold went from like 1750 or whatever, 1800 to 1450, and all the gold bugs. Well, everything's crashing, even gold is crashing. But the truth is that gold was crashing the least of all commodities. So what we're going to see this time is because the Fed wasn't exactly printing on March 16th. It took time for the pipes to start flowing. And so we're going to see some kind of a crash like that again, right? When we're talking about the plumbing blow up in the sewers, and then immediately the Fed's going to print, and then everything's going to reverse.
Rafi Farber stands out as the visionary mind behind the Endgame Investor, a publication known for its insightful perspectives on economics and finance. In this video, Rafi Farber points out that gold reached its highest purchasing power compared to other commodities during the chaotic situation of March 2020. Meanwhile, he anticipates swift money printing in forthcoming crises, resulting in faster reversals than observed in past occurrences. ANZ Bank economists suggest that gold prices are poised to rise with the help of easing monetary policies. In his analysis, Rafi further underscores the extraordinary spike in cocoa prices, attributing it to shortages and weather-related adversities. Concurrently, he observes that while prices are generally increasing, gold and other commodities are experiencing a rise. According to Bank of America Global Research, investment in gold surged to its highest level in nearly a year during the week ending Wednesday, while investors withdrew funds from cash equivalents and stocks. At the forefront of his discussion, Rafi further delves into the historical movements of precious metals, drawing attention to a pattern where gold would ascend while silver stayed relatively flat. Then suddenly silver would rapidly catch up. The secular breakout attempt that is currently ongoing says it all. Silver is trying to stage a breakout. A move higher in the price of silver will trigger a strong bull run in the price of silver. Underlining the significance of being prepared for this shift, Rafi stresses his intention to exchange silver for gold when the silver-to-gold ratio reaches approximately 15-1 or 20-1. Now, we present the clips of Rafi Farber's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
There's been a nominal rise in prices, yes, that's true. But if you look at gold relative to the CRB index, to all commodities, it's not doing any better than any other commodity on average, especially look at cocoa. Cocoa's in a parabolic move now, and it's in deep backwardation. For industrial reasons, shortages, weather, famine in Africa. It might be specific to cocoa, but across the board, all commodities are rising. And really, the peak, the all-time high for gold, right? And this is also difficult to internalize and accept, but it's the truth. It's the truth. When did gold have its highest purchasing power in terms of other commodities? When was its real purchasing power at an all-time high? That was on March 16th, 2020. Right? That was like at the depth of that crazy crash when gold went from like 1750 or whatever, 1800 to 1450, and all the gold bugs. Well, everything's crashing, even gold is crashing. But the truth is that gold was crashing the least of all commodities. And if you remember, at that point, oil was crashing so badly that it went negative. and all other commodities were like just plummeting. So that was the peak of the gold bull market in all of history that day, even though it felt like gold was crashing. So what we're going to see this time is because the Fed wasn't exactly printing on March 16th. It took time for the pipes to start flowing, right? But this time they have their finger on the trigger like immediately, and so we're going to see some kind of a crash like that again, right? When we're talking about the plumbing blow up in the sewers, the monetary sewers. And then immediately the Fed's going to print, and then everything's going to reverse. Instead of taking, what was it, like a week or two in March 2020, it's going to take like a day or two this time. But the move down is going to be even more extreme, and the move up is going to be even more extreme in the reverse. It's an opportunity, but it's also, you have to understand how the price moves historically, and it also helps to understand why from a logical perspective, right? Gold, even in the 70s, gold was making new highs into 1977, 1978. And silver wasn't at all, right? And as gold was moving higher and higher and higher, it wasn't doing anything. And I've showed this chart in a few other interviews from 1975 to 1979, and in 1974 it was like 5 years, silver did pretty much nothing, and gold was making new nominal highs every now and then and climbing. And then all of a sudden, just like 1979 to 1980, just silver went on a slingshot. But that's not the first time it did it. It's not like that's the only time that silver did that, when while gold was making new highs and silver just catches up at the end, right? It happened in 1918. It happened in 1968. This is how silver works. Because from a logical perspective, as the trust in the derivative, the gold derivative, breaks down, that it can no longer be redeemed for gold, then the public, which at that point cannot afford gold, they say, well, if the gold substitute, if the gold derivative, they're not saying this intellectually. They're saying in their behavior, if the gold derivative is breaking down, I got to get rid of these dollars, whether it be digital or central bank digital currencies or physical cash or whatever derivative it is. They got to get rid of them, and so they go after silver because that's the public's money. That's what they can afford. And then you have all of this demand going in all at once when the public finally wakes up. And it's going to happen this time. And then when it does, what I plan to do is move my silver into gold, and then it'll calm down, and then I'll figure out what to do with everything, and decide what to buy. But you're not going to have that much time, so you got to understand what silver is going to do. And when it does, and the number that I'm waiting for is around 15 to 1, 20 to 1 ratio, whatever the nominal numbers are, I don't know what they'll be. But when it gets down to that ratio, I'm going to switch over. And you got to be ready for that.
During the interview, Rafi Farber examined the potential collapse of the dollar and the looming specter of hyperinflation. While stating the vital significance of precious metals, he emphasized the indispensable role of gold and silver as the sole alternatives in this situation, owing to their lower standing in the currency hierarchy. On Tuesday, gold prices surged, supported by a decline in the U.S. dollar, as investors awaited upcoming data to assess inflation trends, crucial for understanding the Federal Reserve's approach to interest rates. In addition, foreign central banks, which hold dollar-denominated debt as a large part of their reserves, will find ways to reduce their holdings of dollars in favor of gold, putting more downward pressure on the dollar and upward pressure on the price of gold. In fact, it has been reported that European central banks, which had in the past been selling gold from their reserves, have stopped doing so, and China's central bank and several other central banks have been increasing their holdings of gold. Moving forward, Rafi speculated on two possibilities in a hyperinflationary scenario, including the government freezing gold prices or continued money printing, leading to the demise of the dollar. He preferred the latter for its potential to facilitate a decentralized financial system reset. Let's get back to the interview.
The end of the dollar and hyperinflation, right? So I come from an Austrian perspective, not in terms of Austrian School of Economics specifically, but in terms of analyzing economics from a standpoint of logic, and only secondarily from empirical evidence, right? So I'm not going to quote historical precedent of this hyperinflation, that hyperinflation, to say the same thing will happen to the dollar, and therefore that's my proof, right? Even though I would cite it as evidence, like this happened there, it could happen here, right? So that makes sense, but that's not my argument. My argument on the hyperinflation of the dollar is that if it does hyperinflate, and there's no other currency to go to, right? It's not like Americans can just get euros instead of the dollar and then start spending in euros or something like the Argentinians do. They hoard dollars because they're trying to keep their savings, and so they kind of step down the pyramid from their dollar derivative, which is the peso, and going to the structural level below that in the inverted pyramid, which is the dollar. But in order to step off the mountain or step off the pyramid, you have to go down a layer, right? Otherwise, if you go up a layer, you're just going to get worse. So the only thing down a layer from the U.S. dollar in the pyramid is gold and silver. That's the only thing that's there. There's nothing else, because this leads into the second question. Look, there's two possibilities here, just logically. Either on a hyperinflationary spiral, the Fed or the Treasury, whoever owns the gold reserves of the United States, could say something like, okay, we're freezing the gold price here. The dollar's going to be convertible again. It's going to be, let's say, $35,000 an ounce. And then we're just going to lop off 3 zeros, and we're back to 1971. It's going to be the new dollar, gold-backed dollar. That would be very serious, meaning that everyone who profits off of inflation, which is pretty much the entire world, would have to restructure the global economy very, very quickly, which would lead to riots and very uncomfortable things, especially in big cities. So in that case, the dollar will not die. It'll continue as a gold substitute, as a gold derivative, as it is now, and then you won't have hyperinflation because they'll just freeze the system. But it's gonna cause chaos, right? The other thing they could do is just keep printing because the constant threat of financial collapse just keeps knocking on the door, so they can't stop the printing, and then they'll end up selling their gold reserves, and then there won't be any gold in the Fed's balance sheet, and then it will lead to hyperinflation, the end of the dollar completely. I think that's the more healthy situation because that would also lead to chaos, but it would at the same time, it would allow us to really reset everything on our own terms in a decentralized way, as opposed to a central power still having power within the currency, even though it is gold backed. They would still have some semblance of power, which I don't want them to have because I've seen what they've done.
In the 1970s, the U.S. experienced double-digit inflation, coinciding with a bull market in gold prices. As global economic uncertainties persist and central banks grapple with inflationary pressures, the importance of diversifying portfolios with assets like gold and silver becomes ever more apparent. Have you considered adding gold into your investment as a hedge against any wild swings in currency values or economic turbulence? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.